Hello guys, today we are going to discuss about mortgage characteristic. Number first, the amount of the loan, and number two, the length or term of the loan. Number three, the schedule for the loan's repayment, monthly installment or lump sum, and the interest rate. Different types of mortgage vary across these characteristics. A fixed rate mortgage is a mortgage in which the interest rate does not change over the life of the loan. An adjustable rate mortgage has an interest rate that is tied to an underlying index at agreed open interval. As the index adjusts, so does the interest rate and the monthly payment. A balloon mortgage has lump sum amount or balloon payment due to at the end of the loan. The most common type of mortgage in US state in the 13-year the fixed rate self amortizing mortgage in which the every payment is the same amount and pays some of the interest. Different requirement than the mortgage used to purchase detached single family homes. For more information on what closing cost can include, see Consumer Financial Protection Bureau. Although the typical mortgage contract may have a 13-year term, most mortgages are paid off early. Borrow pay off a mortgage in a several ways. First, a borrower can repay the loan in full over the prescribed time period or earlier if the borrower makes extra payment. The second, the borrower can refinance the mortgage. In refinance, the borrower takes out a new mortgage, usually with a better term than the original, such as a lower interest rate. Using the new mortgage to pay the original mortgage, the borrower can make payment on new mortgage. Third, a borrower can sell home and use to proceed the repay the mortgage. Lender protection. When taking out a mortgage, the house is being purchased is pledged as the collateral. If the borrower is unable or unwilling to pay, the lender can seize the house and sell it to recoup what is the owed. The increase the probability that the sale of the house will be sufficient to recover the amount of mortgage outstanding and to reduce the advantage to the homeowner of the defaulting. The lender will generally require a down payment. The down payment also serve as the buffer to protect the lender in the event that the house's prices fall. For example, if a borrower want to purchase 4 lakh house, the borrow $4 lakh house to the borrower make a 10 $1 lakh down payment, 20% off in order 20% in order to borrow the 3 lakhs dollar as long the house can be sold for more than amount of the mortgage outstanding. The lender faces little risk of not being repaid. A larger down payment result in a loan to the ratio value, the ratio of the amount of the mortgage, the value of the home. Although the lender typically require a 20% down payment, a borrower could use mortgage insurance instead if he or she not have enough for 20% down payment. Mortgage insurance and insurance policy purchased by either the borrower or the lender through usually by the borrower. The compensate the lender in the event that borrower default. If provided greater insurance to lender of being repaid, the borrower typically purchase a mortgage insurance from private business. Private business mortgage insurance or PMI or the federal government.